based on our methodology of how we value companies. Because when you look at something like Disney, for example, I might value Disney differently than you will. I might look at intangibles. I might look at the retail book value of what does Mickey Mouse mean to the Disney brand. And I might say, because of Mickey Mouse alone, I'm going along on Disney. Now with technology, you can automate that for retail. And now it's becoming to the point where you could start with just $2,000 to have high net worth strategies using technology, which is why I'm so big on fintech.
All right, guys, look, man, we are here with another episode of Cheat Code Unlocked. Today we got some dope guests here, man.
Yeah.
Guys, these two gentlemen are just absolute phenoms in the, investment space.
Phenomenal.
They're out here in Chicago in the Chi-Town. We came out to kick it with them. We met them on Clubhouse, and shout out to Clubhouse and the whole thing there.
Way back, man.
But our guys, Rich and Samir.
My guy.
Man, appreciate you guys. Let me grab y'all. Like I said, bro, these guys are just absolute phenoms in the investment space. So I appreciate you guys coming on.
Definitely, man. Yeah.
Today we're gonna be talking about, getting a little bit background to the people on just how to retire rich. I mean, because that's what everybody wants to know, right? Like, how do we retire wealthy at a young age, not 70, 50, 60, 70 years
Where you can
old,
enjoy your money.
Right. Shout out to those who are 50, 60, 70 years old, but we want to get there a little bit younger, man. So appreciate you guys coming on, man. Yeah, for sure.
You guys having us, man.
Yeah, man, for sure. So let's dive right in. So I've always been curious, right? I worked at 9 to 5 for a long time. I've always been curious. I always heard about, traditional IRA distributions and being able to max out your IRAs and things like that. What would you guys say to the people? Like, I never really got a good understanding just working at 9 to 5, like what exactly all that meant. Yeah. So what would you say is like an advice on how to max out, or should you even max out your traditional IRA, or should you consider using a Roth IRA? What's the difference? You know what I mean?
Well, let me talk myself out of making money real quick. Actually, before you even get into the IRA, so traditional IRA or Roth IRA, which is typically what you would set up with someone like my company or someone like me, you're actually going to want to maximize and contribute to your 401k.
Okay.
And that's going to be not super common, but it's not rare to come across a 9 to 5 employer that offers you a 401k.
Right.
You always want to keep an eye out for if they're doing a match too. Right. People sometimes, a common mistake I see people do is if your employer is only doing dollar for dollar match for the first 3%, and then they don't do they kind of look at that the 50 cents match on the 4th and 5th%, and they don't do it. No,
that's
free money.
Bad deal, right?
It's free money. So you want to start by doing the 401k. Then what you want to do is you want to take a look at your IRA options. Being traditional, which just means tax deferred, meaning you're going to put that money in there. It's going to grow tax free. You're only going to pay taxes once you actually take that money out.
So traditional IRAs are tax free entities, or
tax deferred?
Tax deferred.
Yeah, tax deferred, meaning you put $100. That $100 turns into $10,000. You're not taxed on that growth. Right.
Okay.
But when you take that money out, whether it be $2,000 or $10,000, when you take it out, whenever you're at your tax rate there, then you pay the tax.
Interesting. Okay.
Your Roth is going to be where you pay the taxes up front. And so for the community, if you plan on making more money, which you should, because you're using cheat code, you're learning and all this stuff, then and look, the way I see the future of taxes is we just got our taxes lowered, and the government's spending all this money. I don't see taxes going down. Taxes going down. So if anything, we can kind of assume taxes will go up.
Right.
So we want to take advantage of this time right now where taxes are a little lower in nature, and where you yourself as an individual are probably making less money than you will hopefully make in the future.
Right.
So lock in that tax rate now, and then once you paid that tax in the beginning, now at a later point in life when you decide to take that out,
you got the money. You got the money growing up. There was a story of a guy who I think he put in, I don't know, a couple $1,000, and it grew to like $1 billion plus.
That was Peter Thiel. Yeah.
Oh man, that's crazy.
Yeah, so that's a little bit. There's more. Different. It's a little bit more complicated than what the media makes it seem.
Right.
He basically put it into a Roth account, and then he bought a bunch of shares of one of his own projects that he knew was like severely undervalued.
Right.
And then it grew, and it was Roth,
tax free money. Yeah. So I want to back up a little bit though. I want to kind of dive into you guys, right, and how what it is that you guys do now, right, and how that, what type of benefit that it has for like the average person who's trying to get to where they're going, right? Retirement wise.
Yeah. I would say so. When I look at where we came from, specifically me and my family, they came from Jordan, the Middle East, right?
Right.
And so when they got here, no one teaches you about investing. No one teaches you about education. And part of the things that they do at retirement systems is making sure people are getting the most for their dollar, right?
Mm-hmm.
Most tax efficiently. Where can I invest the money? And 3, when you're looking at even as an advisor, are they making commission on those products, right? Like you always want to be acting in the fiduciary duty. So when you guys are looking at advisors or education, you want to be going to an advisor that's acting in the best interest of your clients.
Right.
That's not looking to make a commission.
Right.
The problem I found early on with my family is they came from a situation where they got into the medical field.
Right.
And in that medical field, of course, you're going to have a lot of advisors that want to charge you the most possible commissions if you're a high earner, right?
Most definitely.
But they still knew nothing about investing. So I took it on when I was 15 years old to learn everything I could about investing.
Man.
And it's crazy. When I had turned, by the time I was 18, there was Apple at the time. I realized, Steve Jobs was still around. We were going to buy iPhones. I told my dad, I was like, hey, man, you should put some money in Apple. I then saw 4 years later what Apple compounded to. And that's when I realized the power of investing. And I became so passionate about it and became investing since 17, 18, became a trader, worked with people like you on the being able to see cheat code algo. And then I got into fintech because I saw not only can we use our brains, but now with technology and finance, you can 10x the speed of it. Which is insane.
So when you now you utilize technology to advance yourself as well as others in the in the financial space.
So now it's using technology to not only advance myself and others, but on the institutional level too. So how can we use fintech to not only advance hedge funds, but maybe RIAs, advisors, make their practices easier, and make everyone's lives easier.
And you're in the RIA space, right? Now, what is RIA?
And how does it work? So what RIA is basically, what it stands for is a registered investment advisory. So you can be a wealth management company and use an RIA. People do that. Once upon a time, I was in that space. I felt that I wanted to go the direct route of just becoming my own RIA. To be honest, it was one of those things that from the outside looking in, it's like you look at people that have had a successful 30-year career in finance and you think like, why didn't they ever just start an RIA? So you think it's like this undoable
mystery
thing,
stuff,
right? It's a mystery, honestly. My business partner Gianni hears me say this all the time. I say having an RIA or having set up the RIA was kind of like putting together a puzzle with no picture. And similar, Mexican background. My family didn't invest in the stock market. They like to buy houses, things that they could see,
real estate, physical,
right. And so, and me, I didn't, my dad, when I told him, hey, buy stocks, he was like, especially Apple was at like $700 a share. When I started, so I started looking at some research. I'm like, all right, what is the supply chain for Apple look like? Who can I can't afford Apple, but who's cheaper, stuff like that, right? But when it comes down to what the RIA will help you do is, people think that you're sending money to an RIA and now you send money to Richard. I'm not. You're not sending money to Richard. You're not even sending the money to retirement systems. You're sending the money to a custodian, so a company like a Charles Schwab or like an Interactive Brokers. And what you're doing is you're giving my firm the ability to direct how it should be allocated. Right. And so that need exists because you as an individual, you're working your 9-to-5 job. You're coming home, you're doing all the things you got to do at home, and you just don't have the time to or to do it yourself or to do the research, and then to stay on top of it. So we come in and we help people with that in a variety of different stages in life, risk profiles in life. Basically,
you help them grow the money. You basically take you guys' skill set, and your resources to basically take somebody's capital that they send over to you as a custodian, and basically they're trusting you guys to make the right decisions under any market circumstances. So, for example, right now a lot of the market has tanked significantly. People who came into the market thinking that everything was sweet, with tech going crazy, are finding a harder time to invest. You guys, making the right decisions and making the decisions that you know best, being with your resources, help people to just continuously beat the market. Is that right?
Right. I mean, something that we ran into, the pandemic happened. Boom. things plummeted, right?
Right.
How many average traders sold at that point in time?
Right.
And then what? They missed the rebound, right?
Right.
Well, I can tell you for our firm, it's like these people that are like, they're calling, they're saying, hey, like, they want to sell, but it's like, you're managing this. It's like, we got to kind of have to like tell them, like, hey,
this is the
eyes
game plan.
on the prize. Right. Like, you're appropriately allocated for this type of a risk of that. You know, it's like.
And do you guys implement? I'm sorry. Do you guys implement any strategies that were like, let's say, what type of strategies do you guys implement outside of just buying and holding shares and stocks? Right. Do you guys implement short strategies? You guys implement, like let's say call options
spreads
and things like that, or spreads? Or anything
so
like that?
Our firm in particular is more in the nature of, name of firm is retirement systems. Right. So most of our demographic is a little bit older. They have more risk averse. They're not necessarily trying to go all out with call options or they're not trying to short any company either. They're just more so looking to make sure they got a game plan. To retire age. Right. They want to retire. They're not at this stage in their life. They understand. They're in their 50s, 60s.
Right. They're not trying to reinvent the wheel.
Right. Yeah. And they understand they don't have the same timeline, right? You're not 20 years old, but you have 30 more years to live.
Right.
If the market drops. These people that are 55, they're 60, their knees start hurting and stuff. They want to retire. Right. And by the way, for those of you guys in the 20s, like, more than ever, guess what? A lot of people that work with me, let me tell you, they have pensions.
Right.
You guys know. And
a
lot of people are entrepreneurs nowadays. You really don't have a pension. You really don't have a 401k.
Right.
So the responsibility on the average individual is higher than ever to start investing for themselves and be doing the right thing.
Right.
To be seeking out technologies, to be seeking out people that know more than them.
Right. Resources.
That's why technology plays such a big part, right? You asked about strategies. You look at things at his firm that he could do that maybe an average retail can't do, is something like structured notes, right? So if you look at a structured note, we can speak about that even. So a structured note effectively is, let's say you really like Roku stock for some reason. Right. That's the stock you want. Look at Roku on the yearly chart. Roku's down like 80% this year. Right. Now, if you went to Richard, you might have had a structured note. You then might be able to actually capture that downside risk of Roku. So Roku might be down 80%. Right. But you might be down only 10 to 20% because of that structured note. So being able to utilize tools like structured notes can really help you.
So structured note essentially, like what? So break that down a little bit more as far as like, what the mechanics is of a structured note. Like what actually is that? I mean, I understand what it does, but what actually does? What actually is it? And can like the average person get involved in that in some way, shape, or form?
Well, the first thing, structured note, I believe you're only going to have access to a structured note through, an operation such like that.
Like an authorized user. Yeah.
Cool. Okay.
And so, basically, as you explained, I would explain it. You can use them for individual stocks. I would say that they're probably a little bit more popular for indexes. So you get S&P 500 and you say, hey, I want a 20% buffer. So if the S&P 500 goes down 18% in this year, I lost nothing. But I also want a good amount of the upside, right? And so people say that. Why wouldn't I just always do that?
That's a cheat
code.
That's a cheat code.
That's a cheat code. I mean, structured notes, they really are,
So, but how does that work? I'm still trying to understand. Like, so you're saying, okay, give me, cover my downside, but still give me the upside. Like, what is that actual asset? Like, what am I trading? What am I trading here? Is it
is it insurance or?
It's basically what it is. It's an easier way for banks to get capital, basically. And so you're basically it's a combination of it's an option chain, right? Basically, it's an option chain, right? And the banks can structure that option chain, and it's a whole lot easier to just offer the structured note than it is to go and raise. Right.
Now, so essentially, I was going to say, so essentially, a structured note provides the bank with more liquidity, using the user as a leveraged instrument. Is that right?
Yeah. Yep.
Okay.
Yeah. And the bank is going to be an important part of that. And obviously, for people, you want to take a look at the credit quality of the bank, right? You don't want to just go and trade with some.
Because that's what I'm going to say. So the structured notes, they're beautiful, right? Because if I'm 55 years old, my name is Craig, and I'm scared about the S&P where we're at. Right. I can now make this contract with the bank. The NASDAQ is down 20%. A lot of people in structured notes on the Qs might have not felt any of that because of the buffer. You might be limiting your upside a little bit with the structured note. However, creditworthiness, what Richard's mentioning here, is key because if you go back to 2008, a lot of structured notes failed. Because imagine if you were with Bear Stearns, which is a notorious company that went under. Right? If you had a structured note with Bear Stearns, you lost your money. So that's why it's important when you're working with you guys and then going to these communities is to educate yourself on where you're getting these from, who's the advisor you're working with. And that's why we look to find this medium between fintech and actual people. So we believe that the future is not all robotic. We believe that there's still a human touch in investing. Because you mentioned your clients, they don't want to talk to a robot if the markets are down 40%. You want to talk to a professional the same way with the doctor.
It's almost like even have like a mentor or psychologist with you because it's everything in the market is emotional, right? So you can't only operate like a robot. You need to have somebody that can kind of walk you through things. But so this structured note situation sounds like a little bit like credit default swaps. Is that similar or anything like that? What is I kind of want to touch on these things because a lot of people hear these things, right? We don't have a full understanding of them, right? So, structured notes, which sounds like a note being a debt instrument in some way, shape, or form, and credit default swaps. Like, what is a credit default swap, and how does it compare to a structured note?
I mean, when you're looking at a company, you grade the company when you're looking at credit. AAA, triple B, triple C. So basically, and by the way, the average retailer wouldn't even use credit default swaps. You have to be at an institution level. And if you look at someone like Michael Berry, the reason people could short those is because you had access to 25, 200 million, 2 billion. But it's important. I like the question because you got to understand a creditworthiness of a company. So basically, I'm looking at, for example, even if you look at Lowe's right there, I can study that as a financial firm. I'm JP Morgan, and they might have a triple B rating. That for the most part, they're healthy, their financials are healthy, they have cash on hand, they'll be good. We can now take their bonds and potentially invest in them. And it's a much more advanced discussion, but we can now have this sort of default swap where based on their credit worthiness, we can invest on the yield. So we're not investing for appreciation when you do a credit default swap, you're looking for the yield.
Okay,
the yield is what's important.
But so the yield goes up as the credit worthiness of the company goes down, correct?
Correct.
So is it a bearish position to take if you invest into something like that, or?
Is it what?
Is it like a bearish position to take if you're investing in something like that?
Sentiment-wise.
It depends how you're looking at it. That's correct. The problem is because if you're an institution, you're usually grabbing so many of them. You're spending hundreds of millions of dollars. You don't. It's not necessarily bullish or bearish, unless you're like a distressed credit fund, which is when you speak about hedge funds. There's different hedge funds. It could be an equity, it could be distressed debt, and you could be taking any position either way.
Interesting. Very different. They're very false shops. I was like, man, I don't know. Well answered. I'll tell you one thing in terms of like, a strategy, because people think, like a structured note can be a strategy, or credit default swap can be a strategy. So we were talking about this earlier. Roth conversion is a huge strategy that I think goes severely underutilized. On Wall Street, I'm calling you guys out.
Call them out.
Gotta call them out.
Bring them out.
So it's violence today, man.
Choosing violence.
Let's go.
I mean, look, I run into this on a day-to-day basis. And the way I would explain it is a lot of people, when you think about advisors, first of all, people think, financial advisors are expensive. They're only for the rich. It's not true. But you think about like the names that come to mind, right? Goldman. This is obviously one of them, right? And so I come into situations all the time. You got to remember, Goldman, a lot of these financial institutions are public companies, right? So they're here to answer to their shareholders, not their account holders, right? And so something that I come across all the time is I talk to a client and say, all right, I'm doing a financial analysis. I'm like, okay, do you have a Roth account? Never had a Roth account. Okay. Well, basically, what Roth conversions is a process of converting your traditional tax-deferred funds that I spoke about earlier into a Roth account. Right? You want to do that strategically. I get people all the time like, shouldn't all my money be Roth? Why don't I take everything? Well, that's all going to count as income in 1 year. So you're going to pay a huge amount of taxes if you convert everything. So really, what a Roth conversion process is like, for example, is, say you're a client, we talk at the end of the year, we say, how much money did you guys make? Where does that put you tax-wise? How much more wiggle room do you have before you would have gone to the next higher tax rate? Whatever that gap is, you convert. and then you're making sure that you don't go into a new tax bracket, and you are putting money into your Roth. You do that every single year that it makes sense to, particularly for people that are getting closer to retirement, because there's a new law that passed called the Secure Act that makes your required minimum distribution age at the age of 72. So required minimum distribution age is just for your tax deferred accounts. The government says, hey, we know you have these accounts, and remember, you haven't paid taxes on them yet. Right? What does the government want? They want taxes.
Yeah,
they say, hey, you're 72, knock, knock.
Right. Where the taxes at?
Whether you want to start accessing this or not, you're going to start. And actually, we're going to increase it year by year. Whether you need the money, whether you don't, doesn't matter. What we need is our tax rate, right? So doing that Roth conversion process helps you out, because by the time you hit 72, if you've converted most of your assets out of a tax deferred account over into a Roth account, well, you can sit there and say, sure, government, come and force me to take the money out of the account that I've already minimized as much as possible. Now what you're doing is you're 72, you don't have to worry about, super high required minimum distributions that are going to push you into a higher tax bracket than you otherwise need to be as a retiree, right? Because now you're a retiree, you should be in a lower tax bracket, right? But back to the point, big institutions like, these public entities, they're not recommending this strategy at all whatsoever. Why? Because you got to think, if they manage $100 billion and then they start taxing this money, right? As a part, it's better for the client. It's in the best interest of the client, not in their best interest necessarily, because now your total AUM just went down. When you do this across billions of dollars, your AUM goes down. Now your revenue goes down.
Now the AUM goes down. Why? Because it's moved into.
Well, because you pay tax. You pay tax when you converted that. You're going to pay that tax eventually, regardless, right? But the bank,
but the moment that you do the conversion, you have to pay tax.
Right. But the bank doesn't want to say, hey, you should do the strategy. You're going to benefit from it in the long run. They don't want to do that, because it's like, well, I'm going to suffer. My AUM is going to go down. My revenue is going to go down.
AUM is assets under management.
Right.
That's how you make revenue.
And that's how these guys make revenue. The more money that they have managing, the more they get a percentage of, the more money they make.
And then the stock price goes down, especially if you're a public company. If your stock price is going down, then you got a whole big deal. And they're not going to execute or recommend this type of strategy.
That's why when you think of the word fiduciary, if there's a takeaway from this podcast, I would look at the word fiduciary, which is, as an obligation, as an advisor, you should be acting in the best interest of the client. But if you guys go back in history and look at 2008, the most people that got screwed was the average retail person. If you think about cheat code algo, you're targeting, educating, empowering retail traders and investors. In 2008, if you look at the statistics, it's quite alarming. Not many of those guys went to jail. I think 1 or 2 bankers went to jail in 2008. Investment bankers. No CEOs, nobody. They actually made a ton of money. Retailers got screwed because you lost 50 to 60% on equities. You're talking about names. You guys are looking at names down. PayPal, Netflix down 70. Citibank, one of the largest banks in the world, got down to pennies on the dollar. Pennies. And the only reason they didn't go under is because the government had to save them. Otherwise, we would have went into a depression. The biggest bank in the world went under. So you have to, as a retailer, understand that. And that's why we're looking to combine not only fintech, but advisors, but trying to stay away from Wall Street, which is there to be profitable for the institution, not us as retailers.
And so you guys essentially would recommend now that, as people who are looking to take our hard-earned capital and place it with people who are going to, essentially manage it in the correct way, so that we can kind of be at peace with our revenue, with our our income, to look for investment advisors, fintech products, and things like that are outside of, I guess we would say, like large institutional publicly traded spaces, because they're not going to find those. They're not going to. First of all, they're going to have that personalized feel that you would with some of the smaller or more direct investment firms. But then also the strategies that are out there available for you, they're not going to be implementing if it's not in their best interest. Is that
That's correct. So I would look at it like this: because technology should make your life easier. So if I'm looking at fintech, for example, there's a lot of strategies within technology that an average retailer person can use that traditionally only the high net worth individuals had access to. Meaning, if you were making 250, 500,000, $1 million a year, you got access to these strategies in Wall Street. Now, as a retailer, you have access to that. One of these things that we look at is this phenomenon called direct indexing. Direct indexing is the idea that we'll look at the NASDAQ, we'll look at the S&P 500, And based on our methodology of how we value companies, because when you look at something like Disney, for example, I might value Disney differently than you will. I might look at intangibles. I might look at the retail book value of what does Mickey Mouse mean to the Disney brand. And I might say, because of Mickey Mouse alone, I'm going along on Disney. So direct indexing was complicated because as an advisor of him, he had to be not only studying stocks, not only looking at the analysis, but he had to go manually rebalance those positions. He had to go tax loss harvest it. He had to go work with his accountants. Now with technology, you can automate that for retail. And now it's becoming to the point where you can start with just $2,000 to have high net worth strategies using technology, which is why I'm so big on fintech. Because now I'm able to just, and no one even knows what tax loss harvesting is.
I was about to ask you, because I remember you just telling me a little bit earlier about the tax loss harvesting strategies that you can implement for, for clients. And I'm like, damn, I mean, I've been trading for forever and I don't even, implement some of those strategies. It's like, man, there's so much out there when it comes to the financial space that can really, give people a leg up and that other, larger income, high net worth individuals have been doing for years. Right. And so like, this really is kind of like the Chico to space. I guess give us a little breakdown on what tax loss harvesting is and how it can impact that, the end user.
Sure. So when you look at taxes is one, if you make money on a stock, you have to pay tax on it. It's a game. What most people don't know is what tax loss harvesting is you have the power, like right now in the markets, most people are down in positions. I hate to say it, right? Everyone's down in some way. What you can do now with tax loss harvesting is you can actually take a loss on a position, not realize it, and go into a different position. And so if I lost $5,000 on PayPal, I took that loss and I went into Apple, and I make $15,000 on Apple, I can harvest 5,000 of those losses from PayPal. So I'm only paying tax on the 10,000 that I make in Apple instead of 15,000. But you wouldn't be able to do that on your own as a retail. You have to go somewhere to Richard to tax loss harvest for you, Maritime Systems, or FinTech, which is like all of us are working on together.
You probably hold the position. People
will hold the position or take a loss because people think tax loss harvesting is different than your capital gains loss, right? Because everyone can write off $3,000 a year. So if you bought Facebook today and at the end of the year you lost $10,000, you can only write off $3,000.
Ain't that some shit? They'll tax you on the full $10,000.
They'll tax you on the full thing,
but you can only write off $3,000. That's some bullshit.
You could lose $100,000 and just write off $3,000. Oh man, it's gonna take me 40 years to write it off.
Exactly.
But if I can use tax loss harvesting now, and I can learn how to trade and I can do things, now I'm reducing my liability. It's one thing to make money in stocks, but what is your tax liability?
Now let me ask you, I got two questions and I hate to take up all the questions.
Please.
I got a couple of them. But one of them being, can you retroactively implement a strategy like this? Let's say before the year end, right? I took a loss on, let's say, whatever company, Apple, let's just say, right? Can you, if I were to say, okay, these are the losses that I've taken, I've realized, or I've sold and took the loss, this year, can I retroactively now go to somebody like Richard and say, hey, can we go back and do a tax loss harvesting strategy, or does it need to be implemented in real time as the trading is going on or as the loss is being,
That would be an advisor's nightmare. It's not that he couldn't do it, but if they came to him last second, I need you to work on this harvest, it'd be a lot of work for him. That's why you want to start that relationship early on, but you can comment on that too.
I mean, that's typically why you look at the second half of the year, especially at the end of the year, and then you always want to be wary of some type of a sell-off. Just sometimes the motivating reason of some of those sell-offs is because they're tax loss. If you're tax loss harvesting, it's big games. So typically, tax loss harvesting isn't necessarily something that you're thinking about doing throughout the year. It's more so like at the end of the year, it's like, okay, let me assess where my positions are. Okay, this one's down, this one's up. How can I offset?
Where can I harvest that? I made $40,000 in PayPal. I lost $18,000 in Facebook. Can I do a difference here with harvesting?
So if you sold those positions earlier in the year, and then now it's the end of the year, and you want to come, talk to an advisor and say, all right, how does this all work out? You can do that.
Okay, cool. And now, what would be the benefit of tax loss harvesting versus just holding? Well, I guess it would be relative then. I mean, because my question was going to be if I were to hold the loss, right? For example, when you're down 12K on PayPal or whatever it is, and you're like, and you're up 40K on Apple, as opposed to just holding the PayPal throughout the year, hoping for a rebound or whatever it may be, taking that loss, off the top. What's the benefit there?
You just don't you're going to realize those gains of that year. You want to hold a position, you can hold a position hopefully it turns back around and you flipped it and now it turns into a profit. If it doesn't, then if it doesn't, then your loss got worse and you didn't offset some of those gains in that year.
And these questions that you're asking, I think it's exciting for the audience because this is where we're going within fintech. The future of fintech is going to be able to ask those questions and real time see what that looks like for you and come up with strategies to work on that, which I think would be exciting because we'll announce a lot of stuff.
Most definitely.
We're working on something.
Yeah, something
that's for
special,
sure.
Man.
That's for sure.
Top secret. That's
So,
amazing.
And it really is dope. So basically, with lending tools and things like that can actually give us basically a zero-sum tax liability potential, or as close to zero as possible to go through tax law services.
Well, I wouldn't say zero. You're on the right track. It's limiting liability as much as possible, but either way, you're going to end up paying tax. It's just making money. It's how you realize it.
Man, that's dope, man. I definitely Rich. You gotta do something, man. Gotta get some taxes.
Gotta do something.
Yeah, man, for sure, bro.
Yeah,
that's dope. I'm definitely looking forward to it for sure.
Yeah.
You know what I mean? And I'm excited to see what you guys come up with, what we come up with together, obviously over the next few months, weeks, etc. Bro. And Rich, man, I think the RIA thing, the structured note thing, I definitely want to talk to you more about that because I think that's something that a lot of people have no idea about, some of the strategies and things like that. But definitely we'll talk about it.
Absolutely.
Yeah, man. Thanks for coming on to Cheat Code Unlocked, man. As always, make sure you like,
use cheat code, man. I wish I had cheat code back in the day.
Actually, tell them where they can find you on all socials too.
Just at Richard Corral, retirement systems.
Yeah.
We stay a little low key.
Yeah.
You can find me on Instagram at my first and last name, Samir.Sawaqed, or just go type in the More We Know podcast on Google.
Yeah.
We're doing some big interviews coming up. Just finished up with Joe DeSanto, the Spartan race, which I'm about to get you all on.
Yeah, for sure.
Mayor of Miami, just getting mentorship. So check out the More We Know podcast, Apple, Spotify, YouTube, and make sure you tap in with cheat code. All of us here, man, we go way back in Clubhouse history.
Honestly, I can't count how many times it was just a joy for me to be like, look, I am not benefiting in any way, shape, or form.
Yeah.
But this is legit. Like, this is going to help you.
Yeah.
I wish I
authentic. Yeah, I know. Yeah. Authentic, man.
Definitely had some good times with Clubhouse, man, for sure.
Yeah.
And I mean, just the value that we gave to people just off the
so much value.
Right. So much value, man. Months and months and months of value.
Definitely.
Man, but thank you, man.
As always. Tell a friend.
Tell a friend.
Appreciate you, man. For sure. Man.